Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that'll boost your trading potential. Coming up, earnings season hits overdrive this week with a flood of major companies reporting, including Apple, Meta, Tesla. Plus, investors are on edge. They're waiting to hear what the Fed has to say. Also, the yen is swinging, the US dollar is reacting, and currency markets are sending signals investors can't ignore. We're going to dig deeper in today's technical take. And our trading debaters are standing by. They're ready to go head-to-head over energy giant Chevron. That's a lot. It's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. An hour to the trading day. Let's check in on the S&P 500. We do have the Fed rate decision tomorrow. The markets are betting we don't get a move from the Fed. Lots of big tech earnings on deck, and the markets are pretty much holding steady ahead of all of that. Let's jump into the heat map. I want to see what's happening in terms of the picture. Oh, we got Apple, Google, Microsoft, Broadcom, putting some points on the table. So ahead of some big tech, maybe a little bit of enthusiasm. I want to check in with some of the big names in health. United Health, Humana, CVS. We could choose anything. We're going to use United Health as an example. All the charts pretty much look like this. These are the medical insurance stocks, of course. They're under heavy pressure today. The Centers for Medicare and Medicaid south of the border releasing a proposal that the Medicare Advantage payment rates would be raised by 0.09%. for 2027, far lower than expectations out there on the market of a 4 to 6% increase. You can see the reaction in those names. I want to check in on Pinterest as well. Didn't think I'd be telling an AI story around this one. They plan on laying off about 15%, a little less than that of its workforce, cutting back on office space. The social media company saying it's relocating resources to AI-focused teams and prioritizing AI-powered products and capabilities. The market doesn't seem to like what's coming out of Pinterest, though. This morning, the stock is under pressure as well. And that's your market update. All right, joining us now for more technical take on what's happening out in the markets is Hiran Amin and special guest star this week, Brian Rogers from our direct investing educational team. Where do you want to kick off here? Are you looking at the broader market here?
Yeah, let's start with the broader market, Greg. Great to have you again back. I know you had a bit of a trek to come into work today.
And now I got a chair that's constantly sinking on me.
Yeah,
so I'll try to boost it back. I'll try to boost that back up while they let you talk.
Yeah, okay. So let's talk about the S&P 500, Greg. Of course, as you mentioned at the top, it's going to be a busy week. We start running into it. More than 90 of the S&P 500 companies are going to be set to report quarterly earnings this week, including Apple, Meta Platforms, Microsoft's as well. It's been pretty good so far on the earnings front. 76% of the companies have reported beating expectations as per FactSet. We've got EPS growth sitting at about, so far with those have reported around 8.2%. But overall, analyst expectation is for 2026, S&P earnings are going to climb to more than about 15%. So that's kind of the backdrop. We did come off of, I would say, a tepid week last week. Volatility is probably the best way to capture it. We saw the Greenland saga unfold. It went one direction, the scales tipped the other direction. We saw a real comeback on the S&P 500. But also, you're seeing that rotation really becoming structural now. Some of the leaders are really, getting in front of the pack. We got the materials, energy companies that are now leading. So Moderna was a leader in the S&P 500 for a second straight week last week. Albemarle, lithium provider. And then we had the memory makers, SanDisk, as well as Micron, kept climbing on that demand. So that's one to keep an eye on. And the one last thing I wanted to mention was on the IT sector. From a valuation standpoint, for the 12-month valuation, they're actually sitting at the lowest point since the post-pandemic environment right now. So you can see it's really struggling to keep up with the pack there. But looking at the charts, Greg, we're seeing that story unfold. What I'm still looking at is the bearish channel is still very much intact. We do have a sideways movement where it has been respecting sort of the upper bounds and the lower bounds. We did have it sidestep below it just recently. This candle, you could see a very big, bearish red candle day. This is on the Greenland when there was more of that rhetoric being at play, and then the framework that was being announced, and we saw that around that when President Trump was at Davos. We saw a real reversal on that. And we're back above the resistance at 69.02. I mark this because this is a previous area where we have seen major resistance. it is acting as a support area right now. But the 69.80 or 69.83 level, that's the key one to top out. So what I would describe the S&P right now is a bit of a topping formation. It really has to break 69.83, hold itself there, close there before we start the next leg up. On the downside risk, we have 69.02 still at play right now where it is. And then further down, 67.90 is a major support area we could test if we have some more geopolitical tension.
And it's a big market catalyst this week with the Fed and earnings. That's the S&P 500, the FXY ETF. If I was better prepared, not running in here like a madman to do the show, I might know what this is. Explain it to me.
You did a good job, Greg. You got it right on
On
point.
the fly.
Yeah. So FXY, it's the Invesco Japanese Yen Currency Trust. So if you essentially wanted to have a play on the currency markets, Invesco has a number of products. In this case, it's Japan. So it's long the Japanese yen, it's short the US dollar, essentially is what this play is. The reason why we're looking at it is, we've seen a real spike in the Japanese yen just over the last, actually coming in over the weekend into Monday, yesterday. This is amid concerns that Japanese and US authorities may intervene to support the Asian currency. So what the real news that shook up just on Friday before the close was the New York Fed and Japan did what's known as a recent rate check. And so what this essentially means is it's calling major banks and just asking them on large orders what they would price the yen at. And this is usually seen as them trying to precursor to actually taking market action and volatility to prop up the yen. It's been obviously in a cut, it's been fallen to close to record low levels. So they wanted to just do a bit of a prop up exercise there. So this got the market, jolted. So we saw the US dollar coincide, obviously drop meaningfully. The dollar, the Dixie's down to I think 97, 98. Kind of was holding the 99 line for a while, and we saw the yen kind of take up quite significantly there. And just sitting right now, I've got the charts pulled up. You can see we've kind of had this long downward trend. We've got a short-term falling wedge pattern that's also emerged here. You can see the fall of the yen since from last fall into the new year right now. But here's the big spike, Greg. We saw this big jump up. It suddenly bursted up above the 21 and 50-day moving average. It's kind of just sitting right below its 150-day moving average, which is quite significant because it hasn't broken that since I would say mid-September there. So this is making some splash. And remember, the reason why the yen is important is, you remember the yen unwind carry trade? So that's kind of where the market's really keeping an eye on this. If the yen continues to strengthen. It's more just about
that currency, right?
Yeah, it's repatriation of the yen, and that means there's going to be a sell-off on the dollar. So that safe haven status, again, de-dollarization, debasing is still at play here, especially with what's happening out east.
All right, two very interesting ones. You have an interesting one for us as well. Brian, CoreWeave, what are you seeing here?
Yeah, CoreWeave, so it's a surprise. It's another technology company, Greg. I know they're in vogue these days for sure. So if you look at CoreWeave, it is a cloud infrastructure company. And the reason I wanted to highlight that one is it's been a tumultuous ride recently. It's a fairly new company. It started out fairly low around the 30s, went up to 187. It's been fluctuating between around 150 and down to $60. So right now there might be a potential renewed interest in this as a turnaround a little bit up to those higher levels. And if we take a look at the chart, here's something I was looking at that there was, just on a short-term basis, there was a couple of key indicators on. There was a triple moving average crossover on the 4, 9, and 18 days. So that was just a minor short-term thing that was driving a little bit of a push to the upside. But then longer term, if you look at it, there is a diamond bottom. I know it looks pretty interesting. It's fancy. It looks like this shiny little diamond there. But really what that is, just to explain it, is there's a trend reversal starts with a period of higher highs and lower lows. And then you get into where it starts to consolidate, where you're getting more higher highs and then you're getting lower highs as well. So it consolidates into this little diamond. And as long as it crosses over significantly on this line I have up here at the top, then you start to see that's a pretty strong bullish signal in many cases. So watching this one, it's not an earnings play. It's not one of the ones that's announcing earnings in the next few days, but it will be at the end of February. So it's one to watch for. Is there going to be a potential run up? They had an investment from NVIDIA, pretty significant, around $2 billion investment to help with the run up on the cloud infrastructure that they're all doing at the moment. And so I think that's pushed it up as well. So it'll be interesting to see as it's going towards its next earnings if that's going to continue.
Great, interesting chart and technical breakdown on that one. Thanks for that, gentlemen. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try the platform risk-free. Open a practice account by clicking on try TD Active Trader. That button right there. And when you're ready to switch to a live account, simply export your workspace and start trading for real. It is time now for the main event, Trading Debating. This week, the stock in the spotlight is Chevron, a major global energy player from oil and gas production to refining. Before we get going with the debate, gentlemen, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now back to the stock of the hour, Chevron. What made you guys pick this stock to debate here?
What does the mantra go like, Greg? Is it drill, baby, drill?
Drill, baby, drill?
Drill, baby, drill.
Was that a 70s disco song?
Yeah, maybe. We're bringing that in vogue, but it simply applies to what we're debating today, Chevron. I mean, in past shows we have done Exxon, so it's good to see, put Chevron back. And they're at a big sort of intersection of trends. The expensive M&A, there's volatile oil prices, and then, everyone's rethinking energy security now, especially with Venezuela and just what happened there. So it's a timely one. We're going to focus on them.
What intrigues you here, Brian?
Well, the same thing in the fact that there's, with the huge focus on oil in the news and just like overall economy, right? There's a major aspect there, especially with what you mentioned on the insecurity in Venezuela and things like that. And we just wanted to see, with all that going on, who would be best positioned to benefit from that. So I think Chevron, it's one of the slickest ones out there for oil companies as they go.
Slick. All right. I think Brian's already given us a taste of how fancy he's going to get. Let's get some time on the clock here. You each get your 2.5 minutes to make your bear or bull case. Then the time to counter. We draw from a hat as always. And Brian's got the bull case. Why don't you kick things off for us? Yeah, you get to go first.
All right. Excellent. Well, as I said, they are, in my opinion, one of the slicker companies. They're not the largest. They're the second largest from a producer in the U.S. They not only pump oil out of the ground, in my opinion, they pump cash. They're just generating cash like crazy. So that's one of the things I want to highlight with Chevron. Few oil companies to survive the multiple market crashes and still remain a dividend aristocrat. So those that have paid, continue to pay strong dividends, and they had enough cash for that return. If I jump into the charts, what I want to do is their bullish case is underpinned by double-digit free cash flow. A few other things on the fundamentals that I talk about, but I want to show on the chart. They have some interesting things going on. You can see in the last little while, these are what's called a morning star. So it's hard to see unless we really zoom in, but you can see where it's consistently where there's a large red candle, where there's a drop, and then there's an indecision. There's just a small candle where there's no movement. It's like a little time period of indecision, and then followed by that is a pretty decent sized bullish candle, so a green candle after that. So you can see there was 3 instances in the last little while, in the last 6 months, where that's occurred. And then obviously over here, if we actually let me highlight that on another chart, but you can see this is a big jump from when we had Venezuela happen. So there was a big gap up. You can see there's that gap up, but it continued, seemed to be the trend continued. It did get filled right away. The gap dropped and it filled temporarily, but then it continued to be on the high side. So then also, if we continue to look at the charts, one other thing I wanted to show was we did have a double moving average crossover at around that same time, to be expected when there was that big move due to the activities and the expectations in Venezuela. So that continued to drive that direction upward at the moment. So we're seeing new highs currently, and there's some other things that I'll look at a little bit later on. I don't want to throw out everything right now, but some things that are driving that upside, and you can see there's some pretty strong evidence on the charts.
Special guest star leaves 30 seconds on the table.
That is impressive.
He's letting the price action and the charts tell the
really
story.
tell the story. Okay.
Well, what do you got for us?
All right, I'm gonna, given that we have some unseasonal weather, that also seems to be catching it on with Chevron. So, when oil sneezes, what's the saying go? Chevron catches not just a cold, but pneumonia. In this case, no matter how strong, their portfolio looks, it's still a commodity-driven business, and that's what my bearish thesis is going to be built on. Let's talk about oil's outlook first of all. So, if oil continues to, its slide due to oversupply or possibly weak demand, it's more of a supply issue right now. Cash flows will fall quickly. When you think about oil's volatility price, you're talking about that will disproportionately hurt Chevron's earnings. We're talking about cash flow, free cash, especially when drilling costs are non-trivial and you have lower cost barrels like Venezuela, which are largely now gone due to licensing issues. That's going to impact Chevron's bottom line. Even Brent crude, I looked at the average to see what are the analysts and the EP, I think it's EIA is what it's called, the government associated. So they predicted oil prices in 2024 were $81 a barrel. In 2025, they averaged $69 a barrel. They're predicting in 2026 it's going to be $56, and in 2027, $54 a barrel. Chevron's bottom line is about $70 a barrel, is where they need to kind of stay healthy, make up the dividends, pay the shareholders, as you said. But they've been consistently dropping their revenue at 6.2 on an average annual rate over the past 3 years, just to put that in perspective. The second point I'll make is about what's known as this reserve replacement hole. So it's basically, the way I can describe it is, imagine running a gas station without putting gas back into the tanker when you're being depleted. So that's what Chevron's problem is. They have the reserve replacement ratio below 100. It really isn't a strategy. They've got a liquidation problem. Their reserves fell to the lowest in over a decade. They were averaging about 88%. They're sitting at about close to about 45% now on the reserves. So they're not making up as much oil as they're replacing out. Looking at the charts, let's go on to that, and we'll save my points for later. But I just want to tell the one story. This is not for the faint of heart, this stock. It is very volatile. I've put it back to 2023. You can see these big V-shaped corrections every time the stock makes a move up. The two things I want to point out to our viewers on the bearish case of this is this one resistance line at the 170, it's a strong barrier. Every time the stocks ever come up to this red line, it's rejected off of that. It's come here, we've seen a second rejection, and I'm going to say we're going to see a third rejection as well as part of this bearish strategy.
All I got in front of me is a bell today, and that almost didn't work. All right, but I got to work it. I noticed a different kind of tone if you watch the show all the time from here and today. It was like concerned parent. I'm not angry. I'm just disappointed. you haven't broken that out of your toolbox yet, so it's an interesting way, way to go.
Okay. Maybe it's different guess. Who knows?
I'm just disappointed. You got 3 minutes now to go at each other. You said you were holding some stuff back, Brian. What do you got?
Yeah, I know this. I'm not angry. I'm disappointed thing. It's kind of like your report card your kids bring it home, and it's not that bad. I think it's not that bad with Chevron in the sense that you mentioned like that $70 oil. You know, a lot of the research I've done is saying that Chevron doesn't get impacted because they are such a large company and they have a ton of cash. They have $32 billion in cash flow from the most recent yearly earnings or yearly reporting. And because they're diversified into natural gas, LNG, carbon capture, hydrogen, lithium, they have a lot of stuff they're diversified into, but they also, because they have the Permian Basin, things that are low cost.
I'm glad you brought up the Permian Basin. And let's talk about the diversification.
He was waiting.
So when you look at the revenue stream of Chevron, upstream makes about 75% of their earnings. So it's about natural gas exploration and drilling. That's what it is. Mm-hmm. I'm going to go back to my replacement ratio and tell you why it's significant, because we talked about how it's low. So how does the company then decide, okay, how do we fill up the reserves, get it close to 100%? What do? You go through an acquisition. Look what they tried to do with Hess and the Guyana Basin. They're basically going in the market and they're spending money to try and do an acquisition, which is embroiled in legal drama right now, with Exxon owning rights to it. So I don't think they're going to make it up, and I think that they're going to be wrangled up and stuck in like the courts until they can get meaningfully anything extracted out of it. But also, when you talk about like free cash flow, look at the numbers. They're going to have to start borrowing or taking debt. Like when you look at the ROE, I know you wanted to bring up the ROE, it's sitting at 7.4%. Now, let me tell you, the 5-year average is 11.2. In 2022, it was 24%. In 2023, it was 13%. In 2024, it was 11%. The trend is going, speaks for itself. If we do operating margin, it follows the same suite. 2022, 17, down to 13 in 23, down to 10% in 24. And net margin, it's the bottom line. It's what matters. It's what pays those dividends, Brian. 15% in 22, 11% in 23, and 9% in 24.
Well, I think trying to put you on the ropes.
Yeah, I was going to say, I think those margin numbers are important. I saw that too, where they are down a little bit. But one of the key things, if you're an investor, oftentimes you may look at the margins. A lot of people may not look at the income statement that closely, but the cash is king, and the fact that those things can be manipulated because of the fact that they have so much cash and they've used that to buy back shares. If you look at Exxon as a comparison, their cash flow was per share, on a per share basis, was some estimates around $2 lower.
But the free cash flow is down though, right, Brad?
Yeah, but it's
going down
still
year
higher
over year.
still higher than other competitors. They've got that cash.
They must be borrowing at some point. They're going to have to start borrowing into those coffers to pay for those.
A lot of that they've been using to purchase Hess and to buy back shares, and that's driven the stock price up. And I think that'll continue to do that because they plan to buy a lot more back, and they're reducing costs by around $2 to $3 billion a year. So that's.
I'm going to go back to my charts and I'm going to say, look at this rejection that is waiting to happen on this earnings. We got Q4 25 earnings coming up. I think if history holds and history rhymes, we should see a major rejection off of this 170 level. I don't think they're going to breach it, especially on the long-term average there.
Tactician.
I like it.
I noticed you watching Heron watched the clock and he knew when there was 12 seconds
Getting
left.
right at
Bring
the
me
end.
back that chart.
He is the pro, though.
He had that planned out. You got a vicious streak in you this week. All right, nice back and forth, gentlemen. Want to jump into the charts, jump into the platform, possible ways to play this through option strategies. Brian, you led the conversation. She'll jump in and show us that bull strategy.
All right, sounds good. Like you said, how history rhymes.
Yeah.
All right, so I am from an option trade. Let me actually see if I can show the trade itself first. So I'm just going to zoom out here. I got to zoom out onto a 1 year if we are showing the chart. So this is just a look at the trade. I know there's a lot of text on that at the moment, but if I can pull it up, I have it down at the bottom here. I do have the trade itself. As long as I can open this up. There we go. It would be about a $19 trade. It's going to cost $19. It's a diagonal spread. And once I pull this back down, you'll be able to see the whole thing. But what that is we're going to be buying a long-dated, so it's further into the future, Greg, long-dated January 2028. So you're going pretty far for, hoping for slow growth type of thing. And then you're selling a short call for around March. So this is a shorter dated call. And the idea is it's a diagonal spread because you're doing a covered position, but it's a $5 higher that you're selling for. It's going to cost you about $19, so $1,900 total. But the hope is that the stock may climb up incrementally, and then you can also sell about every 40 days, sell another call and collect more income and pay for the entire trade. Wow. So that's the idea behind it. If we just want to hide this, we'll hide the, if we're sharing the screen, we'll hide that, and you can see on the trade itself, you can see that it's a net debit around, yesterday it was about $19.50, it's around $19. And you can see that you're selling a 175 that's short dated, you're selling or buying a longer dated. And the idea is, if you can see some of the text here, it's saying there is a little bit of an assignment risk on the short option, so that could happen, meaning you just might have to buy that back and then do it over again, just sell another one, because you don't really want to sell your long option because you paid so much for it, right? You don't want to sell it unless it happens way further into the trade. But if you look over here on this this idea of a payout, just down at the bottom, max loss is roughly around that $19. But I just want to move this over so everybody can see it. But if you sold calls about every 42 days, I think it's approximately around 770 days to get to that 2028 date, you would be able to pay for it in about 13 quarters. So about 13 40-day quarters, you'd be able to pay for the full trade. And then you'd also even get on top of that potentially, if the stock goes up above the 170. So you still have that risk. You always ask the risk, Greg. You have that risk of if it does drop, if the stock does drop, you're limited to a defined risk. You're limited to whatever you paid for the whole position would be your loss. So roughly about $1,900.
All right, interesting strategy there. Brian, how about the bear side here?
Well, if you're of the bearish inclination, you could do, again, this is going to be a high conviction trade, Greg. We did one similar last week where you're just expecting the stock to make a downward move and you want to play it out. Again, looking at the chart and looking at, there's a couple things I want to look at when I'm especially coming into earnings. One is the implied volatility profile. Where is it sitting? So if implied volatility is higher, we know we can get a sort of compression of volatility. So right now it's the 58th percentile, so that's more conducive to when you want to sell options, you want to take advantage of that implied volatility crush. But also the stock doesn't make big moves. It's the expected, market is expecting about a $5 move based on the options pricing right now. So we're doing what's known as a double bear spread trade, Greg. So here's how it works. So we've got at the top, we've got a bear call spread essentially. So we're looking to sell the 170 call, which is the level that I marked where we're seeing multiple rejections happen. So we want to sell there, and we want to buy further out, about 10 points out is what the spread is in this case, 180 call. This is for the February cycle we're looking. So that makes up one part of this trade. The second one, which is the directional move, is the bear put spread. So on the downside, we're looking to buy a put at the 165, which is just out of the money right now. Chevron sitting at 167. And we're looking to, again, keep the distance the same, 10 points out, and sell the 155 put. Now, this trade, in fact, because we're doing a sell, Greg, and we've got a long put spread where we have to put money into it, this helps offset the cost, this bear call spread. So essentially we're paying, it's a debit trade. You try and want to do it for net even, which is like almost close to zero, but in this case we're paying 65 cents on a single contract, or $65 is what we're essentially paying on this trade here. And now,
the reveal, the risk and the
reveal.
reward.
Let's do it. Okay. So it is, as I said, it's a directional trade. So we want to not get wiped out on this as best as we can. So let me start with the max loss. So if the trade doesn't go the way we want it to, in other words, if it breaks higher and can go into the 170, we will start making a loss. The max loss is going to happen once the stock hits the upper strike at 180. Then we have a max loss. In this case, is going to be $10, which is the full spread realized value, plus what we paid for to get into this entire trade, 65 cents, or in other words, $1,065. And the max gain, however, is if it does work in our favor on the downside, we just needed to break below 164.35 for us to start making money on this trade, and we max the profit once the stock reaches our lower strike price at 155. In that case, it's going to be the difference between the spread and what we paid, $9.35, or $935 is the max gain on it.
If it breaks below that lower bound, is there any?
We're capped, yeah. This is the beauty of doing a spread, is we always want to define our risk so we don't get wiped out, and we just take it on the chin and live to fight another day, essentially.
All right, good stuff, gentlemen. Thanks for laying out the bull and the bear cases for Chevron. Just a reminder to our viewers that this debate was for educational purposes. It does not reflect our personal opinions about the stock. Before we move on, Brian's going to show us what we can do with the account overview. What can we do with the account overview, Brian?
Well, you can see your account for one thing, Greg. That's I know it's not the most exciting or fancy thing, but I do like to go to this because of the fact that, if we show on Active Trader right now, if we can jump to the screen, I'm in the activity and position screen. It defaults there automatically. We're going to have the account overview, and you can see, your total account value, your buying power, ton of different stuff listed there. But I just wanted to show that you can edit this. So if you click on the, we always call this the hamburger menu. If you click on that, you can go to metrics customization, and you can add and remove some things you may not want to see. Let's say if you never short stock, as an example, you can get rid of the stock market value short, like just drag that and take that off. So then you're not seeing, information that you don't necessarily need to see, right? So if you just click apply if you want to make those changes. But the other thing I wanted to show is because, it might be a pain, you can customize. I know we've shown this a ton of times, where you can customize this platform however you like. But if you didn't want to have an account overview on every tab, like let's say if I go to trading, it is there. But if I go to analyze, it's not there. If I go to research, it's not there. If I want to be able to see my account, we do have up at the top, we have this header. This header there, and it's basically a lot of the same information, and you can click on that and you can see there's a drop down if you want to just see what's going on with your account. But you can also customize this too. So you can go to header customization right here, and you can select whatever you want there as well. I like to look at options market value long, because if you're doing long options, or your stock market value long and so on. But then most importantly, you have your day profit and loss, your year to date and so on, and you can look at it at a moment's notice there. So that's the only other thing I was going to show is you do have the ability to actually hide. Actually, is it on this section, the privacy thing here?
It's at the top, right?
On this one, right?
Yep.
Oh, there it is right there. Yeah, I just lost track of where it was for a second. Yeah, in the header, you do have the privacy. So, I work from home, so oftentimes nobody's looking at mine, but if you're in an office, then you're going to be able to sometimes say, hey, I want to hide. I don't want everybody to see my balances and my accounts and things like that. You can click this privacy button right on the header, and that'll do it not only here, but then just on the other side, you can see on the account overview. Nice. Now you've got that starred out where not everybody's seeing your business.
Yeah, where I sit right now, there's a highway behind me of people. So everyone sees my business all the time, but
Exactly.
Now that you have
so it's handy where you can turn that off.
That's the way it is. Nice trick. If you have at home, have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, send us an email at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. If you scroll down, you're going to find a tab that says Join a Live Masterclass. This Wednesday, 2 p.m., our very own Jason Natick is hosting an interactive session about TD Active Trader. It's going to explore all the main features the platform has to offer. Registration is open now. Before we wrap up the show, let's talk about a few things that we are focusing on for the rest of the week. What is on the radar for investors? This side of the border, we got the next double header. We got the Bank of Canada in the morning with its rate decision, but of course, then the big event for the global markets and the American markets, FOMC.
It's FOMC. You're right, Greg. So it's a big week for monetary policy, as you said. This will be their first meeting for the new year. In fact, they're making the decision at Wednesday, 2 p.m. as usually. But also, there's a possible announcement of President Trump's pick for the Fed chair. That's still been lingering. He did the interviews in December, or supposedly, and we still have to wait for that announcement. So possibly we could have that come out. But on the FOMC side, markets widely expecting the Fed to keep rates unchanged in that 3.5 to 3.75 range. This is following 3 consecutive cuts they've done last year. Reuters polls, Reuters did a poll. Economists are unanimous in expecting no rate change, but with also 58 also forecasting that rates will remain on hold through the rest of this quarter. So basically, that'll wrap up essentially Fed Chair Powell's tenure as chairman. But ultimately, the markets will probably look for a cut now, looking at the June, July in the summer, a 25 basis points cut there. But what's going to be key is, again, it's just the communication. What's the path that they're going to be communicating? And it could possibly mean it could move the dollar, especially if Chairman Powell is going to brings more of a hawkish tone, especially with the data they've ingested so far for January in terms of PCE and inflation in the labor market there. So that's one to keep an eye out on. And then it's earnings. We got to turn our attention to it.
Let's take one of the big tech names.
Yeah, we're going to look at the big one. Apple, again, it's kind of the barometer, as usual, kind of informs us about the space. So again, considered the world's most valuable consumer technology company, built on the iPhone, a powerful ecosystem and enormous cash flow for them. So this will be the Q1 results that are coming out on Thursday after the close. And expectation is on the EPS side, $2.67, which is 11.2% year-over-year growth, still in double digits. And also on the top line, $138.4 billion at 11.3% year-over-year. I just balk when I see those kind of numbers on Apple on a quarterly basis.
The cash pile, everything about Apple.
It is huge. So iPhone is going to be probably the single most focused because it's the single product category that drives engagement across its broader ecosystems. So, expectations are going to see, we want to hear what the demand is like. We want to hear how China is. They've kind of taken the number one spot back again when they lost it for a while there. So, and also the manufacturing base. Remember, they still manufacture a lot out of China. So have they kind of moved some of that supply chain away in the recent while to kind of fight off some of the tariff worries there. So that will be one thing. And then the second thing is they've also got cost pressures. Memory is going up, memory pricing, and DRAM memory specifically, direct random access memory. So that's another thing we want to hear if that's going to eat into some of the margins there. Tim Cook did say, in October that they expect revenue to grow 10 to 12% in this holiday quarter. So this might be a big one if they can meet consensus and beat it. But looking at the charts, it's kind of saying that same story. We've seen kind of a strong bullish channel rise in the price. It kind of hit this all-time high at 288. We topped out just kind of in walking into December before the end of the year, and we saw maybe what I would say is profit taking at this point, where there wasn't materially anything that caused the sort of slide, but we did see it start a new sort of short-term downtrend. Usually this is part of a healthy market. Anytime you see a long-term uptrend, any sort of minor correction is going to give away at least 30% of the previous move that had happened. In this case, we saw it come down and tag the 245 level. It's finding quite a bit of support here. And just this week, we've seen, and leading into last week, we've seen a big bullish candle push up above the 150. And today, you can see the price has just poked its head and sitting on the 21-day moving average. Still needs to cross over the 50-day. It's still a bearish move because we have the 21-day sitting below the 50-day. But we want to see that 21-day cross to confirm that move. Coming into this earnings, market's expecting about a $10.50 expected move. So we're looking on the top side about 265-ish. On the downside, we're looking back at the support at the 255 level right now.
All right, great chart work there on a big story of the week. What do you got for us? Your beauty. You're casting your eye on beauty.
Yeah, absolutely, Greg.
Yeah, poet's soul.
Beauty never sleeps.
Elf beauty, to be exact. And that's the reason I wanted to look at that. It does have earnings coming up on February 4th, but it's also, I've heard a lot more recently about the lipstick effect, this idea that these small indulgences that people, even when the economy, if they're worried about their jobs, or worried about the slowness in the economy, they're still going to buy those small indulgences, right? And this company fits really, really well into that. It's a US-based cosmetic and skin company that creates affordable beauty products. And Greg, do you know what ELF stands for?
Probably not something out of mythology. It's ELF. It's emergency liquid formula for lips.
That's a good guess. And actually, I didn't know this until researching. It's eyes, lips, and face. So that's
That makes
all
sense.
their products
That makes sense.
Okay.
are around. Yeah, so you can remember that. You can easily remember what these guys do. The reason I wanted to look at it, as I said, is if we take a look at the chart, it did have a bit of a dip. It dropped down significantly. The market didn't really like its last earnings that happened in November. And so the one coming up in February, there's a bit of expectation from analysts and some chart movement here. You can see, after this gap, we see a cup and handle. I know that's Huron's favorite metric to look at, so we can see that's usually a good bullish sign. And then it did, shortly after that, have a price crossing the moving average. So the 21-day crossed the 50-day, and that's coming into shortly going into earnings. So I think there's going to be potentially a bit of a run up to earnings, and then we'll see what happens. If there's strong earnings, then maybe it could be something to take a closer look at, like beforehand, and then otherwise we'll see after that what does transpire in the eyes, lips, and face market.
Lips and face market. Look at that. I take away a big learning from today's show on top of everything else you guys laid out. Thanks for that, guys. That's the show for this Tuesday. We're back on Thursday at 10 a.m. Eastern Time. We'll be speaking with technical analyst JC Peretz from Trend Labs. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.